Everyone thinks the 2008 financial crisis fixed banking. They were wrong. In March 2023, something happened that proved the entire system is still rotten, and nobody's talking about what's really coming next. Silicon Valley Bank didn't just collapse. It revealed that banks are running a Ponzi scheme, and they've been doing it for decades. The shocking part? The government knew it was happening and did nothing. This isn't about one failed bank. This is about the death of American banking stability. And what you're about to learn will change how you think about your money forever. Hey, today we're peeling back the layers on the Silicon Valley Bank (SVB) debacle. Not just what happened, but why it exposes a systemic rot that's still festering. We'll cover the historical build-up, the mechanical breakdown that turned complacency into catastrophe, the current dangers to your deposits, and a chilling outlook on what's next. If you have money in a bank, this is must-watch. Stick around, knowledge is your best defense. Historical context. Let's go back to where this all started. After the 2008 meltdown, regulators swore up and down, never again. They rolled out Dodd-Frank in 2010, imposing stricter capital rules, banning risky trades, and mandating annual stress tests for big banks. The narrative was clear. The system is now bulletproof. Safer lending, better oversight, no more taxpayer bailouts. But here's what they didn't tell you, and what history now proves. They never actually fixed the core problem. They just swept it under a thicker rug, hiding it in plain sight. From 2010 to 2021, the banking world entered a bizarre new normal. The Federal Reserve, desperate to juice the economy post-crisis and through COVID, pinned interest rates near zero, sometimes even negative in real terms after inflation. Quantitative easing flooded the system with cheap money. Banks were swimming in deposits, but traditional lending to businesses and consumers at low rates wasn't profitable enough. So, what did they do? They gambled on safe assets. Think about it like this. If you're a bank getting nearly free money from the Fed and depositors are happy with 0.01% interest on their savings, why risk lending to a small business at 3% when you could buy long-term US Treasury bonds or mortgage-backed securities yielding a guaranteed 1.5 to 2%? It seemed foolproof, low risk, steady spread between funding costs and asset yields. No defaults, no drama. Except there was massive hidden risk. Banks were essentially betting that the Fed would keep rates low forever. No hikes, no volatility. This duration mismatch became the industry's dirty secret. Short-term liabilities, deposits that can flee anytime, funding long-term assets, bonds locked in for 10 to 30 years. Silicon Valley Bank took this bet to extremes. Catering to the tech startup ecosystem, SVB exploded in size. In 2021, they held $61 billion in deposits. By end 2022, that ballooned to $189 billion, fueled by venture capital cash pouring into Silicon Valley unicorns. SVB parked a whopping $91 billion, over half their assets, into long-term government bonds and mortgage securities bought at rock-bottom yields. Their playbook: hold to maturity, collect the coupons, and profit from the interest rate arbitrage. It was the epitome of complacency. Regulators saw the balance sheets during stress tests, but waved them through, assuming rates would stay suppressed. No one questioned the concentration. 93% of SVB's deposits were uninsured, over FDIC's $250K limit, tied to volatile tech firms burning cash at record rates. The stage was set for disaster, built on the false promise that post-2008 reforms had eradicated such vulnerabilities. But as we'll see, it was all an illusion. Mechanism breakdown. Here's how this setup morphed into a full-blown catastrophe, step by mechanical step. It all ignited in March 2022, when the Fed, battling soaring inflation, peaking at 9.1% that summer, began hiking rates aggressively from near zero to over 5% in just over a year. Now, here's the dirty truth about fixed income securities like bonds. Their market value moves inversely to interest rates. If you bought a 10-year treasury at 1.5% yield in 2020, and new bonds now yield 4.5%, your old bond is suddenly worth far less, maybe 70 to 80 cents on the dollar to attract buyers. For SVB, this meant massive unrealized losses. Their $91 billion bond portfolio, pristine on paper if held to maturity, was underwater by about $15 billion in market value by early 2023. That's a huge hole in a bank with just $120 billion in total assets at peak. Normally, this isn't fatal. Banks can hold to maturity, HTM, and avoid booking losses, waiting for bonds to pay out at face value. But SVB had layered on another fatal bet: eternal depositor loyalty. Their client base? Venture-backed startups flush with VC money but hemorrhaging cash on growth. In the go-go years of 2020 to 2021, easy funding rounds kept deposits sticky. By late 2022, however, venture capital dried up amid higher rates, and economic uncertainty. Deal values plunged 60% year over year. Startups needed liquidity fast, pulling deposits to survive. Enter the Ponzi element. Banks like SVB rely on a constant inflow of new deposits to cover outflows, but when the music stops, the scheme unravels. On the 8th of March 2023, a prominent VC, Peter Thiel's Founders Fund, advised clients via text and email, "Move your money out of SVB now." The message viralized through Silicon Valley's tight-knit network, Slack channels, group chats, Twitter DMs. Panic spread like wildfire. In just 3 days, $42 billion, over 20% of deposits fled SVB. To meet the redemptions, they couldn't just dip into cash reserves, only about $13 billion liquid. They had to sell bonds at a loss. On March 9, SVB announced a $1.8 billion loss from selling $21 billion in securities, trying to raise capital. But the damage was done, the math broke. With $15 billion in total unrealized losses exposed, confidence evaporated. Regulators seized SVB on March 10, marking the second largest bank failure in US history. SVB wasn't alone. This was the tip of a systemic iceberg. First Republic Bank mirrored the exposure with heavy long-duration bonds and wealthy, uninsured depositors. It failed soon after, sold to JP Morgan. Signature Bank, focused on crypto and real estate, collapsed under similar deposit runs. Even giants like Bank of America reported $100 billion plus in unrealized bond losses in 2023. The Fed intervened with the Bank Term Funding Program, BTFP, lending against par value of bonds to provide liquidity, essentially a backdoor bailout. But the core issue persists. U.S. banks hold over $600 billion in unrealized losses on securities. As of late, 2025 down from $690 peak, but still massive. If rates stay high, more losses materialize. If rates drop sharply, deposits migrate to higher-yielding money markets, now at 5% plus, starving banks of cheap funding and forcing asset sales. It's a no-win trap, with regional banks most vulnerable to this interest rate whiplash. Current implications. Let's zoom in on what this means for you right now in 2026 and beyond. First and foremost, your deposits might not be as safe as advertised. FDIC insurance covers up to $250,000 per depositor, per bank, but in a systemic crunch, the fund is woefully undercapitalized. As of Q3 2025, FDIC reserves stand at about $128 billion, while US bank deposits total $18 trillion plus. If even 1 to 2% fail, like in 2008, claims could exceed $200 billion. The government would backstop it via taxpayer funds or borrowing, but expect delays, haircuts, or inflation as fallout. Uninsured deposits, 40% plus of total, are especially at risk. SVBs were 93% uninsured, leading to instant panic. Second, the Fed is in a policy straitjacket. They can't hike rates further without triggering more bond losses and failures, as seen in 2023. But cutting rates risks rekindling inflation, still hovering 2 to 3% above target or asset bubbles. This gridlock stifles economic growth, keeps volatility high, and erodes confidence in central banking. Third, and this is the big structural shift, regional banks are being squeezed into oblivion. They lack the diversified funding, for example, credit cards, wealth management, of megabanks, making them prime targets for deposit flight. Post-SVB, we've seen accelerating consolidation. JP Morgan's assets swelled to $4.1 trillion by 2025, absorbing failed peers. This creates too big to fail on steroids fewer, larger banks with even more systemic risk. Dodd-Frank aimed to prevent this. Instead, it accelerated it by burdening smaller players with compliance costs, while big banks game the system. Fourth, even as markets stabilize somewhat, the specter of unrealized losses lingers like a dark cloud over the sector. As of Q3 2025, U.S. banks reported $337.1 billion in unrealized losses on investment securities, marking the 14th consecutive quarter of elevated figures. While some relief came from falling rates in late 2025, any unexpected uptick in long-term yields could inflate these losses further, eroding bank capital and forcing more defensive strategies. This vulnerability not only hampers banks' ability to lend aggressively, but also heightens the risk of credit crunches during economic downturns, directly impacting small businesses and consumers who rely on accessible financing. Fifth, the consolidation wave is gaining unstoppable momentum, reshaping the competitive landscape in ways that could hurt everyday Americans. In 2025 alone, over 181 bank mergers and acquisitions were announced, the highest since 2021, with deal values surging, including October's record $21.4 billion tally. Heading into 2026, this trend is expected to continue, driven by regulatory pressures and technological disruptions, leading to fewer choices for consumers, potentially higher fees, and reduced innovation in local banking services. As megabanks dominate, the power imbalance grows, making the system not just more fragile, but also less responsive to community needs. The end result? A more fragile, concentrated banking oligopoly where failures cascade faster. Your everyday banking loans, mortgages, small business credit gets pricier and scarcer as regionals vanish. Ending. Conclusion. The Silicon Valley Bank collapse was supposed to be a wake-up call, a stark reminder that post-2008 reforms failed to root out greed and complacency. Instead, it became Exhibit A in how dysfunctional the system remains. Banks can still gamble with your deposits on interest rate bets. When they lose, the government steps in with liquidity lifelines and guarantees. Depositors get spooked but ultimately bailed. Taxpayers foot the indirect bill through inflation or debt. Executives, they walk away with millions. SVB's CEO sold $3 million in stock weeks before the crash. And the cycle repeats, each time with higher stakes. The question isn't if this happens again, it's when and how bad. A bigger bank like First Republic II? A regional domino effect in a recession? Or a full systemic freeze if rates swing wildly? We're one policy misstep away. Protect yourself. Diversify across banks. Keep under FDIC limits. Explore high-yield alternatives like treasuries or money markets. Stay informed, don't trust the all-clear from regulators. Thanks for watching this deep dive. If it shook you up, like, subscribe, and hit the bell for more on financial threats. Comment, is the banking system fixable, or are we doomed to repeat 2008? Check the description for resources on safe banking. See you next time, stay vigilant.